when share prices are getting cheaper, it essentially asks us the question, why are you not buying more of this company? Conversely, when valuations are getting more expensive, now that might be for a good reason. We need to do the analysis, need to do the work, but if it gets to an extreme, why are you not selling this company and buying some of the cheaper stuff?
Hello and welcome. Today on Basis Point, we explore the sheer diversity of profiles that make up asset management and one particularly singular path. We met Ben Peters, co-founder of Evenlode Investment, a boutique focused on long-term equity investing. Trained as an astrophysicist, Ben didn't come to markets through finance textbooks or the City of London, but through science, uncertainty, discipline, and serendipity. Together with his brother-in-law, Hugh Yarrow, he went on to build a fund business guided by strong convictions, patience, and a clear view of what makes a business worth investing in over time. Thank you so much for watching our content. Our community is really starting to grow, so don't forget to like, comment, and subscribe to keep that momentum going. Today's episode is about how different perspectives shaped an investment philosophy and why consistency mattered more than fashion from day one. Okay, let's go. Seriously though, Ben, you're a physicist. So what are we even doing here? What made you switch from physics, hard science, to finance?
Yeah, it's an interesting story. So I was a physicist as an undergraduate. I studied astrophysics, and then I actually trained as a physics teacher, and I taught physics and science in London for a time. But I'd got interested in the world of investment actually through my brother-in-law, who I started the Evenlode Investment business with. He was a fund manager in the city. I've got no background in finance at all. And over the sort of noughties, he gave me a few books to read, and it piqued my interest. And while I sort of didn't really know what I wanted to do long term in my science career, I'd ended up doing a doctorate at Oxford, doing some doctoral research. I'd got interested in the world of finance, got interested in the world of investment. And then ultimately in the world of sort of businesses and I guess broader economics. And it just really interested me because the physical world is very, very, very interesting, and I loved science, but there's something that was sort of curious about economics and the way it involved people, plus in the world of investment you can do analysis as well. And I think it was that combination of people and analysis that really got me interested in the world of investment.
So you kind of got into it through an interest in economics, you said, so kind of top down?
Yeah, sort of both top down and bottom up. So I mean, I've been given books about Warren Buffett, as many people have been, and other sort of investment greats like Seth Klarman and Joel Greenblatt. And that kind of idea that you could select companies and analyze them interested me. But I was also realized that, having done this reading, I didn't really know much about the economy. I didn't know how the economy worked. I'd never really thought about it. And when I started to read and, broaden my knowledge, I realized this was such a fascinating area. And it turned out that one can have a career in both of these worlds. So I then sort of started exploring potential career paths, but we had also, myself and Hugh, my brother-in-law, had started talking about the potential for running a business together. And then ultimately that became the Evenlode Investment business, but there was a little bit of a story to its launch, I suppose.
We'll get back to that. So obviously as a trained scientist, as a physicist, you were good with numbers. I mean, hopefully.
Reasonably, yes.
So coming into finance as a trained physicist, what edge did you have on other people who didn't train in hard sciences?
Well, I think there are those hard skills, like you say. So data analysis, I suppose, is an obvious one. Grasp of numbers, although most, unless you're doing some complicated sort of exotic derivatives, the maths is not that complicated, but the idea of sort of dealing with large data sets, that sort of stuff, is a natural thing. I think there's also a sort of soft skill, which is that I sort of understood what I could know and also what I can't know. And I think, I was doing research on, in my doctorate, on these sort of very small systems, individual molecules in a very controlled environment. And even in that controlled environment, I didn't know what was going on 100%. I could know pretty well, but the whole point of experimental science is that you don't really know what's going on. So if you apply that to the broad economy, what can we know? That's the analytical bit, but there's so much we can't know. And how do you deal with that? I think that that's a really interesting challenge and something that actually really kind of got my brain going. As an aside, I was also quite interested in the ideas of behavioral science as well. So psychology, I suppose, and what's now become behavioral investing as a style or a concept at least. So that was part of what fed into the interest as well. So I think there are those sort of more philosophical points about knowledge and what you can know and what you can control and what you can't that come from my scientific background.
It's interesting because there is quite a contrast there, because I mean, having worked in the past with scientists, a lot of them did not want to express any sort of opinion on something that they had not studied, published a peer-reviewed paper on. They won't have a firm opinion. And then you get into finance, which is a business of opinions, and people making decisions based on these opinions. So everybody has an opinion, as opposed to science, where everybody's super careful before they're able to actually express an opinion.
Absolutely, and I think I did have to let go of that notion quite quickly. And I think I quite quickly grasped that whilst yes, we do analysis, we take it very seriously. We do our homework. Ultimately, yes, it's a matter of opinion, because we're always dealing with the uncertain future. Clearly, that's what investment is all about. So yes, it's important to be in some way rigorous, but also, yes, you have to come to some useful conclusions, which is essentially our job for our clients.
So what were you absolutely not prepared for as a scientist coming into finance?
So many things. I think there was certainly a great deal of naivety on many things. I think what surprised me was how much finance and investing is a people business. And I think it relates to what you were saying about, the idea of analysis. I think there was definitely, I thought that analysis was the main thing and relationships was sort of the second thing. They're at the very least equal, or at least perform equal roles in different ways.
So when you say relationships, in terms of building trust with your clients?
Yeah, on that side, certainly, absolutely. On the client side, relationships are really, really important. We put a lot of store in communicating with our clients. We're very active, as in different to the benchmark strategies. Clearly, sometimes that's a really good thing in terms of relative performance, sometimes not so much. So I think it's really important to have a trusting relationship with clients, for sure. But then there's also the companies that we're investing our clients' capital in as well. And we have to, of course, there's lots and lots of rules and regulations and, accounting standards and all that sort of stuff. But ultimately, there is a sort of trust that we have to have, with the best of our analysis and the best of our research. We are committing our clients' capital to those companies. So there is a relationship on that side of things as well.
Tell us a bit about the origin story of Evenlode.
I got interested, as I say, through Hugh, and he gave me some books to read. And this was in the pre-Great Financial Crisis era, so sort of 2004, 2005. And we realized we had a affinity. We got on well. We had been talking about investment for some time, and we thought we had a pretty clear idea of, if we managed a business, what would that look like, and how would we manage our clients' capital? The plan, such as there was one, was that I would leave my scientific research when it was done, get a job somewhere, in finance in the city, probably get some experience, and then maybe at some point in the future we would realize this idea that we'd had that ultimately became Evenlode Investment. Then the financial crisis came along, which happened to be when I was coming to the end of my research. And I did apply for a few jobs. Nothing really worked. I think that's because of the financial crisis and not because of me, but I don't take it personally. But actually, Hugh's father, who ran a wealth management business, he's now retired, but was looking for someone to help him out with that at the time. And cutting a long story short, I went and worked with him for a while, and then Hugh had the opportunity to leave his position, and he gave me a call one day and said, well, how about we do that thing we were talking about? And we decided, yes, we had to. We had to do this. It was a great opportunity to do it. And we knew, we preached long-termism in our investment approach. We knew it was going to be a long-term endeavor. We needed to build a track record. And we thought, well, the sooner we get going with that, the better. As I say, there's probably a lot of naivety about what it would then take to build a business, but we learned by doing and improved what we were doing through time, and ultimately started getting some relationships with clients. But that early germ of it was really kind of born out of the financial crisis, really, and an understanding that long-term track records start on day one.
Here's what I was going to say, because raising money with no track record is probably the single hardest thing to do in fund management.
Absolutely, and as we discovered, it was a bit of a slog, to be honest, for the first few years. But we were very lucky, actually, in a way, in that we were in charge of our own destiny, really. We didn't have external shareholders who were sort of bearing down on us to raise lots of capital immediately, and we knew that things could, if we had a fair wind, work out well in the fullness of time. So we were willing to be patient, and I think that's something that you see in the culture of Evenlode Investment to this day, and I very much hope it will be in the next 18 years of the business and onwards. So yeah, I think that idea that we could start things and then develop them from there and be patient, I think that was key to actually getting going at all.
Accept the idea of not starting big with a bang from the get-go.
Absolutely.
You told me that you guys were about quality at a reasonable price. Can you kind of get into that and what it means and how you do that?
Yeah, absolutely. I think this stems from our idea of being business first investors. Of course, we use the stock market to invest, but ultimately what we're doing, and this is the thing that really got me interested in investment, was it's about investing in businesses. And so understanding what businesses do and investing in what are quote unquote good ones or quality ones or whatever word you want to use to describe them makes sense. And there's also the notion that the price matters. And I suppose actually I'd skipped over this bit in my earlier comments, but my first experience of investing was actually in the dot-com bubble. So when I was actually in my late teens and got caught up in that kind of excitement, and and luckily I didn't have very much money to lose in the dot-com crash, but I did lose a bit, and that was instructive. So I think that the idea that even a good business can be the wrong investment at the wrong price kind of got drilled into me then, and then from my subsequent reading. But ultimately, and I suppose this is the sort of latter Buffett years, if you like, the idea that if you invest in good businesses, they compound and you can do very well out of them. That's the basic idea. But the reasonable price bit is they don't have to be the cheapest businesses in the world. We don't run a deep value strategy, but we don't want to overpay by the same token. And if we get offered a good price for something that we own, well, perhaps we should move on and buy something that's cheaper. So this is the idea, I suppose, buying low and selling high seems simple, but also the idea that that's actually quite difficult to do. Humans find it quite tricky to do that. And so when we were putting our investment process together, guarding against the sort of psychological need to do something else that is very difficult for us to buy when share prices are depressed. We wanted things that were going to guard us against that as well. So within it, the quality at a reasonable price is something that a lot of fund managers will say is a shortcut for what they do. But for us, it was really about being disciplined, doing that one thing, but doing it really well with discipline so that our clients understand what they're invested in. Our clients understand that they don't have a portfolio. I think this is topical at the current time, that's very overvalued, that is at risk from valuation. But ultimately, if it compounds away, then they're going to have nice returns over a long period of time.
I was going to say, looking at tech and AI stocks for the past couple of years, you can't get around them, and yet they're super overvalued. So how do you explain to your clients that these aren't the companies you might want to be invested in?
It's sometimes a challenge, and I think it's important for us. We do talk about tech, we talk about other areas of the market where there's excitement, but ultimately it's what assets do we own, why do we own them, why are they good? Do they have high returns on invested capital, great market positions? Are they willing to invest in themselves for the future? So are they good in that sense? What are the valuations? Are they comfortable? That's really what we set out to our clients to do. And if we do those two pillars, quality and value, and we deliver it and we can explain it, then clearly it's up to the client whether that's enough for them. Now, for some clients, they want to go into the
new shiny thing.
The new shiny thing, and there's nothing wrong with that at all. And we need growth investors. Equally, on the other side of it, I think we need deep value investors as well. I think it's important for the active management community to actually act to set an appropriate price for assets, and that can be in growth, value, and quality as well. but we focus on the quality bit. So, I think as long as we do that and our clients understand what it is we're aiming to deliver, that's kind of as much as we can do as active managers, and then clearly it's up to the client whether that's okay for them or not.
You talked about long-term as an investment philosophy. I mean, I'm guessing a lot of people say that because it just sounds smarter to invest long-term. So how do you actually ensure that you do think long-term in your investment process?
I think you're dead right. I mean, a lot of people say it. It's very difficult to do. And one of the reasons it's very difficult to do is because investment cycles actually happen over a long period of time. And that means outperformance, and it also means the flip side, which is underperformance. And I think we're in one of those periods right now where our style of investing is not very fashionable, and that's probably been going on for 3 years.
Because of the tech hype?
Partly because of tech hype, partly because of other things like excitement around defense spending, for example. So capital goods companies, which tend to have low returns on capital, don't really fit our process, but they've been performing very well in the market. Banks have been performing very well. So I think there's a number of reasons, and then that's even ignoring the sort of whole passive debate and how that's affecting.
We'll get into that.
But we do think about that. But whatever the reason, performance for quality as a style has been very much out of favor for quite a long period of time. And I think that's one of the reasons to think in any investment approach, unless you're a sort of hedge fund or a trader or something like that. I think it's important to think long-term. I think it's important to think long-term if you're a value investor. But it's very difficult to do. And I think this is where, for us, the structure of our business is really helpful. We've been very deliberate in setting our business up to be independent, to not have external shareholders. So the business is owned by an employee ownership trust, which is designed to be the long-term ownership home. So we don't have a sort of external pressure, aside from for our clients, to do anything other than what we're doing. Hopefully we do that really well. So long-term is said a lot, as you say. I think it's very difficult to do. And we've been very careful to actually set the business up, the structure of the business and the team up to actually deliver for the long term. So in terms of our investment approach and the actual process, we have developed a proprietary software system which kind of embodies and encodes a lot of the principles that lie behind our investment approach. So it's very much technology enabled, but is not a quantitative strategy. So we do a quantitative analysis. We also do a lot of qualitative analysis. So actually right before our conversation, I was talking to a business that we might invest in. It's a German, very high quality kind of industrial company. We do that work as well. And our system, our platform, which we call Eddy, brings together that qualitative and quantitative knowledge and is the sort of guardrails that guards our investment approach and guides us towards certain types of decisions. So, for example, we have our valuation discipline is encoded in this system. When share prices are getting cheaper, it essentially asks us the question, why are you not buying more of this company? Conversely, when valuations are getting more expensive, and that might be for a good reason, we need to do the analysis, need to do the work, but if it gets to an extreme, why are you not selling this company and buying some of the cheaper stuff? So I think we've been very careful to put in guardrails which help with our own cognitive biases, which we all have as humans.
And so where does this investment process and looking at quality companies that are reasonably priced, in what industries has that taken you?
Yeah, so we started off with a UK version of what we do because there was myself and Hugh. We were in the UK. kind of made sense. I'm now the lead portfolio manager for our global income version of what we do. So deliver some dividend, but it's very much a dividend growth idea. It's not a sort of high yield strategy. And then we also have a global unconstrained version of what we do called Evenlode Global Equity, Evenlode Global Opportunities on the continent. And there are those different flavors. Typically developed market listed businesses. We could invest in developing market listed businesses as well. We have looked at a number over time. We haven't felt the need to so far because actually you get sort of global exposure through developed market listed multinationals. So it's typically US, Europe, plus some other markets like Japan, Australia, those sorts of markets. By sector, there are some pretty core sectors. It's probably easier to say what the sectors where we don't find companies that fit the bill. So specifically, sort of basic materials producers, so miners, oil producers, so in that kind of part of the energy space, real estate, so inherently low return on capital business models, or where the company creates a product which is essentially the price is set by the market and not by the company. So we want price makers rather than price takers, if that makes sense. So conversely, sectors where there are a lot of companies that do fit the bill, information technology is one. We happen to be very underweight information technology right now, but that's because of valuation, not because of the qualities of those businesses, which can be very, very, very good businesses, clearly. A lot of network effects, etc. Consumer goods, business services, some capital goods companies, if you're looking at the industrial sector, but where they have a sort of value adding niche product that can fit the bill. But it tends to be business services in that area for us. Healthcare selectively as well. So it's those sorts of sectors where we find businesses that fit the bill.
That was very interesting. Thank you very much, Ben. That's it for today. Don't forget to click below to subscribe to the official Basis Points YouTube channel.